Welcome to Huge Library Audiobooks. Today, we bring you one of the most life-changing financial books ever written, The Intelligent Investor by Benjamin Graham. This book is not about chasing fast profits. It's about learning how to think, how to stay calm, and how to invest intelligently, no matter what the market does. Benjamin Graham was not only a brilliant economist, he was a teacher. He shaped the minds of legendary investors such as Warren Buffett, Walter Schloss, and Irving Kahn. And thanks to later commentators like Jason Zweig, his wisdom continues to guide new generations. We're going inside on this book chapter one by one. Number 1, investment versus speculation. Number 2, the investor and inflation. Number 3, the market's history and lessons. Number 4, the defensive investor. Number 5, common stocks for the defensive investor. Number 6, the enterprising investor. Number 7, the market fluctuations and Mr. Market. Number 8, mutual funds and professional management. Number 9, the margin of safety. And number 10, emotional control. Chapter 1, investment versus speculation. Graham starts with a timeless question: are you an investor or speculator? An investor studies. They focus on the real value behind a business. A speculator guesses, hoping to make a quick gain. Benjamin Graham learned this lesson the hard way. In 1929, during the great stock market crash, he lost more than half his fortune. But instead of giving up, he analyzed every mistake. He discovered that most people didn't lose money because of the market. They lost because they were gambling instead of thinking. Years later, he wrote this book to protect others from the same fate. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Chapter 2, the investor and inflation. Inflation, Graham says, is like a slow fire that burns your savings over time. Even so-called safe investments like bonds lose value when prices rise. Irving Kahn, one of Graham's earliest students, understood this deeply. Kahn lived to be 109 years old and continued investing even past 100. When asked how he survived so long in the market, he said, "I learned patience from Ben Graham, and patience is how you protect your money from time and inflation." He diversified between strong companies and cash reserves, never betting on trends, only on value that lasts. Chapter 3, the market's history and lessons. The stock market moves through cycles: boom and bust, hope and despair. But history proves that the patient investor always wins in the long run. Walter Schloss, another of Graham's students, mastered this. He never worked on Wall Street. He simply bought undervalued stocks, companies no one else wanted. Over 47 years, his fund earned returns higher than Warren Buffett's, without computers, analysts, or fancy models. Schloss once said, "Ben taught me that you don't need to be smart, you just need to be disciplined and stick to your method." That's what Graham meant by intelligent investing: discipline, not genius. For the defensive investor values peace of mind above all. They seek stability, not excitement. Graham advised defensive investors to hold about 50% in stocks and 50% in bonds. Choose large, established, dividend-paying companies. Hot trends and emotional investing. Warren Buffett once said, "Ben Graham gave me the framework for all my decisions." I'm 85% Graham and 15% Phil Fisher. Even Buffett, now one of the richest people on earth, began as a simple defensive investor, buying safe, undervalued companies and holding them patiently. Chapter common stocks for the defensive investor. Defensive investors can still profit from stocks if they focus on quality, history, and dividends. Example: Buffett's early investments in Coca-Cola and American Express followed Graham's advice: buy strong brands with solid earnings and loyal customers, then wait. Patience turns time into profit. Chapter 6, the enterprising investor. Some investors want more challenge, more reward. For them, Graham describes the enterprising investor. This investor looks for opportunities others miss: a small company ignored by the market, a stock temporarily depressed. Walter Schloss was a perfect example of this. He said, "I buy cheap stocks. I don't care if they're boring." And his simple method, buying undervalued, unwanted stocks, made him a legend. You don't need excitement to succeed. You need consistency. Chapter 7, the market fluctuations and Mr. Market, Graham introduces a character called Mr. Market, your emotional business partner who offers to buy or sell your shares daily. Some days he's joyful and offers high prices. Other days he's depressed and sells cheaply. Your job is to take advantage of him, not be controlled by him. Warren Buffett once explained it beautifully, Mr. Market is there to serve you, not to guide you. In 1973 to 74, the U.S. market crashed almost 50%. Buffett stayed calm, bought more of good companies, and came out much wealthier when the market recovered. That's the essence of intelligent investing, turning other people's panic into your opportunity. Chapter 8, Mutual Funds and Professional Management. Graham reminds us that even professional fund managers make mistakes. High fees, emotional decisions, and short-term thinking hurt performance. He encourages individuals to invest directly or through low-cost index funds. Jason Zweig, who updated the modern edition of The Intelligent Investor, reinforced this idea: for today's generation, you don't need to be smarter than the rest. You need to be more disciplined than the rest. Zweig's commentary makes Graham's old wisdom fresh and relevant for our fast digital age. Chapter 9, The Margin of Safety. Now we reach Graham's greatest lesson, the margin of safety. Always buy below true value. If you believe a company is worth $100 per share, never pay more than $70. That $30 difference protects you against mistakes, inflation, and uncertainty. Benjamin Graham used this rule to rebuild his fortune after losing everything in the Great Depression. Buffett, Kahn, and Schloss all followed the same principle. It's simple, but it works forever. Chapter 10, Emotional Control. Markets rise and fall, but emotions swing faster. Fear and greed destroy more wealth than any recession ever could. Graham's students all learn this lesson differently. Irving Kahn practiced patience, sometimes holding a stock for 20 years. Walter Schloss never watched daily news. He looked at company reports once a year. Buffett avoided crowds and media hype. Jason Zweig reminds modern investors every generation thinks it's different. It's not. The tools change. Human emotions don't. Closing the legacy of Benjamin Graham. Benjamin Graham died in 1976, but his ideas are eternal. He turned investing from speculation into a discipline, a science of logic and behavior. Warren Buffett still calls The Intelligent Investor the best investment book ever written. Irving Kahn lived more than a century following Graham's rules. Walter Schloss beat the market for 47 years using Graham's teachings. Jason Zweig keeps Graham's philosophy alive for the digital generation. And now, through this audiobook, so can you. To achieve satisfactory results is easier than most people realize. To achieve superior results is harder than it looks. Be patient. Be rational. Be disciplined. That's how you become an intelligent investor. Thank you for listening to The Intelligent Investor by Benjamin Graham, brought to you by Huge Library Audiobooks. If you found value in this audiobook, please subscribe so you never miss another audiobooks that build your mind and your future. And if you want full book is free, I put link on description. Thank and see you others audiobooks.